Yeo Chen said it was the Augusta Rule, Section 162A, 179, the Airbnb, which allows me to keep my W-2. Andrea said yes to the accelerated depreciation. All of you guys found a lot of value in some of the real estate related strategies that we talked about yesterday because I believe a lot of you guys believe in real estate. Do you believe in real estate? Put a yes in the chat box if you believe in real estate. Put no inside the chat box if you don't really like real estate. Listen, for me, I wanted to choose real estate because of my mother. My mother was an avid real estate investor growing up, and I remember when I was young, me and my brother Kenny, my older brother, we would travel with my mom and dad to these random states like South Dakota, North Dakota, Idaho, and there was no beaches there. And me and Kenny were always just kind of bummed out. We're like, damn, why are they bringing us here to these random hotels to go like look at these houses? And we never realized that my parents were actually operating as real estate professionals. They were managing their own rental properties. And over time, they built up a real estate portfolio that allowed for them to have passive income to live off of, but simultaneously have tax write-offs that they can offset their tax bill with. So I want to ask you guys, are you guys here today because you're not just trying to save money on taxes, but you're trying to build generational wealth, but not generational wealth for you and your spouse. You want to build generational wealth for your children. You want to build generational wealth for the next heirs. And be honest, put that inside of the chat box if that is you. And if you don't mind sharing with me, what is the reason why you want to build generational wealth? Do you know why you want to build generational wealth? What is it for? Is it so you can have more time? Is it so you can spend more money on stuff? Is it so you can just go travel to some random island and be there for a month or two? Why do you want generational wealth? I want to ask you guys that. And I want you to get it laser clear on exactly what it is that you're looking for. For me, I wanted to have financial freedom, not because I knew financial freedom meant I didn't have to worry about money. I wanted financial freedom because I wanted to be able to spend more time with my family. When I lost my grandmother back in 2019, it was very hard for my family. And I remember wanting to do so many things with my grandmother before she passed away. And then shortly after that, in 2020, my grandfather died. And that's when it really hit. My mother was super close to my dad, even closer to my grandfather than she was to her mother. And just seeing my mom just completely torn up because she didn't have any more time with her father, it showed me how important it was to have money. You see, having money isn't just about spending it on stuff. Having money is about creating opportunities for you to spend with your family. Put family inside of the chat box if you agree with me. Now, what I want to do here today is I want to give you guys access to a strategy that we didn't discuss at all this week. It's a strategy that I've never talked about on my YouTube channel, a strategy that I've never covered on my Instagram. I may have mentioned it in a podcast video. I may have mentioned it on a Instagram story, but never in a post. And the strategy is called IRC 181. So if you're here with me right now and you're interested in learning a strategy that can literally 4x your investment dollars, put yes inside of the chat box. Put hell yes inside of the chat box, because I would like to bring on one of my senior tax advisors to explain this strategy to you guys. But before we bring her up, I want to make sure I get at least 200 yeses inside of the chat box. Who in here wants to learn a new strategy that we've never discussed on our YouTube channel, on any social media channel, that can provide you a 4-to-1 deduction? I want to get a ton of yeses. You guys heard from our clients that came up yesterday, AC Mata, we had Bao Lee, and what they all shouted out was, dude, I had Christine in my corner. She was helping me get my tax plan in order, and I'm already situated for my taxes for 2025. And so without further ado, I want to bring up Tax Alchemy's senior tax advisor, Christine Nelson, to teach you guys the IRC 181 strategy, and more importantly, how you can make an investment into a movie film between now and the end of the year to offset possibly 100% of your income taxes. Without further ado, Ms. Christine Nelson.
Hello, how are you?
Aloha, hello, how are you? Christine, we have a group of individuals here today that are all trying to figure out ways to save money. Christine, I'm going to turn it over to you today. This film financing strategy, you introduced it to me, and it took our entire company to another level. Now I have money invested in movie films, our clients have money invested in movie films, and everybody on here today wants to know, what is this all about? Because my CPA has never shown this to me, so how does this strategy work?
Okay. So it's quite simple, but quite powerful. So I'm going to share my screen here and we're going to talk about film financing. So film financing comes from an IRC code called 181. What 181 allows you to do is certain films that are produced domestically that make certain qualifications are able to deduct the entire cost of the production in the first year. Okay. So what happens is a film production is identified that meets the qualifications of 181. An LLC is set up, and then investors such as yourselves can put money into the film to close the budget on the movie and receive tax deductions. So we use seller financing. So let me explain kind of how this works. So if you were to put $100,000 into film financing, you would get a 4x deduction on your investment. So you put 100,000 in, you are now a partner in an LLC that owns a piece of a film, okay? To get the $400,000 deduction, you are signing a recourse loan with the producer for the remaining 300,000. This is not a credit check loan. This is not a bank loan. This is a loan with the producer. Because this is a recourse loan and you now have risk or skin in the game with the 300,000, you now have basis in the entire investment and are able to take the entire 400,000 deduction in the first year. Okay, so let's look at an example. So if you put $100,000 into a film, you sign a loan with the producer for $300,000 recourse loan, you are at risk for 400,000. You get a $400,000 deduction in the first year. At the top tax bracket, federal 37%, you are saving $148,000 this year. Okay, here's another example. Let's say you put 500,000 in. Every investment is 4x deduction. So if you put 500,000 in, you're getting a $1.5 million recourse loan, $2 million deduction this year, which at the top tax bracket could save you $740,000. Just depends. Do you need to put in 100? Do you not? So there are a lot of different options of things that we can do. Now, one of the most important things to know is that no matter when the film comes out, no matter how it does, you get the deduction this year. But how does it work with the repayment of the recourse debt? Okay, so when the film is finished, it goes to the theater. It might be in the box office for 10 to 12 days. Then it's sold to streaming services like Netflix, Hulu, Prime, whomever. When the revenue for the film starts coming in, the revenue that would normally come to you as an owner in a piece of the film will first go to pay off that recourse debt. Okay, you need to know that that is income to you when it happens. Okay, so if you did, in our previous example, if you invested 100,000 and you signed 300,000 recourse loan, let's say you did that this year. All the films that we currently have, we think are going to be released into the theater at the end of 26. Okay, so that means that most of the revenue is going to be earned in 27. So in 2027, the first $300,000 that you would earn on the film would go to pay off that recourse loan with the producer, but that is taxable income to you in that year. But presumably you're going to be working with tax alchemy and we're going to be planning for that. And we're going to know that in 2027, there is going to be revenue to be recognized on that film, and we will have another strategy in place to mitigate that. In the meantime, you get this nice deduction this year, and with the time value of money, you've put in 100,000, but you've saved $148,000 this year. Okay. There's also an opportunity for you to make money on this investment. If you put $100,000 in, you might make 20 to 40% on your investment in the film. It just depends how the film does. And we just don't know that yet. So we're, on average, the average is a little higher, but I go with 20 to 40% to manage expectations. So if you put in 100,000, you might make 20 to 40,000 in 2027, but you're going to have 320 or 340,000 of income to pick up. Here is an example of some of the films that we have had clients invest in. Off the Grid with Mark Dumal, Mark Wahlberg, movies, Stallone movies. We have 4 movies currently. So these are big movie pictures that are going to the theater. These are not your neighbor's son putting together a movie. These are big movie pictures that are very well vetted. I have worked with this for 3 years. Our contact has worked with this for 10 years, and we have never had a film not finish. Every film has finished, every film has gone to the theater, and there has never been any recourse debt called on a partner. It's not to say that recourse couldn't be called on the partner, because that's the nature of recourse debt. You are signing that you guarantee that debt if it's not paid by the revenue of the film. But we have never had that happen. And we do not anticipate that happening because we have very highly vetted these films, and they have done very well. Carlton, back to you.
I'm here. Christine, the questions that are coming in are absolutely amazing right now. I'm going to bring myself up with you. This is great. And by the way, I'm going to get an opportunity to share with you guys some of the K1s that I had from some of these investments. But Christine, if you don't mind, can you share with us, what does seller financing mean? Because for a lot of people, they're used to going to a traditional bank and getting a loan, but the way in which we structured the IRC 181 is through a seller finance through the movie producer. So can you talk about what does that even mean?
So the movie producer is basically fronting the money, giving you time to pay off this money. Okay. You're putting in 100,000. You have every faith in this film. You're closing the budget on the film. The producers then taking their money and putting it into the next big thing. So in turn for you closing the budget on that, they're letting you sign a 300,000 recourse loan on the 100,000 example, right? So you have time to pay off this loan over the course of this project. The average life of the project is about 5 years. It really just depends on the film. But because you can pay this over time, but yet you still have risk, you have basis, which allows you to take a full deduction in the first year.
So Christine, if I'm hearing this correctly, this is very similar to me, almost like writing off a vehicle, right? Because if I buy a car as a business owner that weighs over 6,000 pounds, I can put a down payment down on the vehicle and then finance the rest of the debt essentially to purchase the vehicle, but then I'm able to take a business deduction based off of the percentage of business use, which could be 100% if the vehicle is 100% business use. So if I have a car, let's just say for example, if I have a vehicle that costs me $100,000 and I put a down payment down of $5,000 and I finance $95,000, I'm taking on $95,000 of debt. I have $5,000 of at-risk capital, but I'm whole for a $100,000 vehicle. I can write off $100,000 if it's all 100% business use. Is that correct?
Correct.
Okay, so that's with the vehicle. Now, when we bring it over to the seller financing on IRC 181, what you're essentially saying is that I'm going to make an investment to become an owner of the movie film, but I'm also going to take on some debt, just like when I take on debt of buying a vehicle. The difference is that when I purchase money into a movie film or purchase assets of a movie film, this actually has the ability to cash flow. Whereas if I just buy a vehicle for my business, that vehicle's just sitting in the garage. It's not really going to make me any money.
Correct.
Okay.
Correct.
So this is where I want people to focus on is, what is at-risk capital? What does that concept mean? Because I want to make sure everyone understands it here today, Christine. And what is recourse debt? So everyone understands that.
So the recourse debt piece is you are guaranteeing that amount with the producer. You are taking a loan and you are guaranteeing that if it is not turned with revenue from the film, that you are going to cover that debt.
That's right.
So let's say the movie is horrible and it's a stinker. Okay, let's just say, and you make enough back, but you're short 20 grand. Technically, the producer could come back and say, hey, you're short 20 grand, cough up your 20 grand. But here's what's not going to happen. That's not likely to happen because this has not cost the producer anything to finance this with you. They're upfronting their deductions to you. It's not costing them anything. Yep. And let's be real, they're going to want you to invest in the next film. So instead of taking your 20 grand, they're going to say, hey, I have a new project. Do you want to put 100 in my next new big project?
Yep.
So we have never had that happen where the recourse loan has been called on a partner, but I cannot say that it couldn't happen because that is the part that gives you the skin in the game or the risk that allows you to take the deduction up front.
Yep. Now, Christine, people can invest in these movies as an individual or they can invest as an LLC, correct? So talk to us a little bit about what would make the best sense for investors. Should they consider an LLC or should they consider just investing as an individual?
Most people, 9 times out of 10, people will invest as an individual. And here's why. There's not a risk of liability because you are buying into a pre-established LLC that owns a piece of a film. So you don't have personal liability. You are a partner in an LLC that owns a piece of a film.
Yep. So I'm already underneath an LLC.
You're already underneath an LLC. You can have an LLC or an S Corp be an owner, but that's not necessary. And how this works to report in your return is you receive a K-1 from this partnership because you are a partner in this LLC. Annually, you receive a K-1 and report this in your tax return.
Yep.
And that's how it flows through to you on your return.
Now, Christine, when it comes to real estate investing, we have a lot of clients that they try to qualify as real estate professionals, but if they can't qualify as real estate professionals, which means they can't spend the 750 hours managing their own investment property and showing that they're spending more time in real estate than any other thing, a lot of our clients will look to short-term rentals. And they will go through the short-term rental strategy because of the time requirement. The short-term rental only requires 100 hours of material participation, and then our clients can manage the property, and then as long as their tenants are staying 7 days or less, we're all good to go with the cost segregation study. But when it comes to being an active participant in a movie film project, what is required for somebody to be able to claim active losses against W-2 income, 1099 income that can come from an LLC or an S corporation?
So there is 100 hours participation requirement, okay? But it is literally as simple as turning on your TV, watching movies. Have you ever spent the weekend watching Netflix with a pizza on a rainy day? You got a lot of time. And I bet you have more time than you think. So I have literally read the IRC code. It says in there, active participation is 100 hours of watching TV, watching movies, or doing other things. There are other things that you can do. You can do research and other things, but it's very, very simple. So what we typically do is send people a survey so that they can log their time. So you do need to keep a log of your time in case you were ever audited, but it is very simple.
Got it. So Christine, you just made something very, very clear to me. There is a time requirement in order for me to take advantage of this strategy, and there is documentation that's required in order for me to take advantage of this strategy. So for those of you guys that are here today, what is the time requirement that Christine just shared with you? Put it inside the chat box if you're following along. She mentioned the time. Andrea, thank you. Sue, Aline, Dina, Madeline, Elisa, Alan Hampton. She said 100 hours. What are you spending those 100 hours doing? Let me know in the chat box. You're watching other movie films. Why would watching other movie films help you to qualify for IRC 181, where you're going to become an investor in a movie film? Why would it make sense for you to go spend time watching other movies? Does anyone know? Why? Do you want to invest money into a movie that's a dud? Or do you want to invest money into the movie that's the next Harry Potter, the next, what's my favorite movie? Oh my gosh, Back to the Future. I freaking love Back to the Future. Anytime that movie comes on TV, I turn into Marty McFly in my living room, okay? So I get super excited. But here's the thing. Wouldn't we all love to invest money into the next J.K. Rowling film? Wouldn't we all want to invest money into the next Rush Hour movie? Wouldn't we all want to invest money into the next Harry Potter, the next, Jason Statham movie? We would love to invest money into these movies that we know are going to be smash hits. How are we going to know which movies are going to become the next smash hits if we're not doing any type of research on other movies? This is why I love the tax code, because the tax code operates the same way whether I'm investing in a movie film or I'm investing in real estate. Because if I'm going to go invest in a short-term rental, should I do research on which short-term rental I should buy? Do you think my building value versus my land ratio matters for me when I'm going into a short-term rental or I'm going to do a cost segregation study? Do you think the location of where I buy, like California versus buying in Florida, Texas, or Arizona, do you think that matters? Put a yes in the chat box if you think it does. Put no in the chat box if you think it doesn't. So you can do tax strategies extremely passively if you want to, and you'll never be able to benefit from the losses that can offset your active forms of W-2 and 1099 income. Or you could choose to play an active participant, which is the tax game that we've been teaching you this week. You can be an active participant in real estate. Sure, it requires you to be a real estate professional. You're going to sacrifice 750 hours in the year. Maybe that's not something that you can do, but your spouse can do it. Or you can choose to do the short-term rental strategy. 100 hours, more time than any other person, but guess what? You got to go into escrow between now and the end of the year in order to get that done. And yes, you do have time if you're working with our team. You do have plenty of time if you're working with our team. But wouldn't it be nice if Christine came to you with a tax plan and she said, listen, even if you don't close escrow, I already got you for a movie film with Jason Statham or a movie film with Mark Wahlberg. I'm going to have you put $100K in. You're going to get a $400,000 deduction. How many of you guys would be really stoked to hear about that? Put a yes in the chat box if you would. Put no in the chat box if you wouldn't. Now, here's what I want to be on your mind if you're thinking like a true investor. What type of returns can I expect with an investment like this? Because if you're listening right now, this is exactly where you should be in your mindset. You should be like, okay, I understand the strategy. Christine already explained it. I see how we can relate this to a vehicle or a short-term rental strategy. Material participation is material participation. Now, what is this investment going to return for me? Christine, although we can't promise return investments because every movie film is different, talk to us a little bit about how money is returned to the investor.
So typically the recourse debt is paid off first, and then any amounts above and beyond that are paid just as in any other investment as a dividend quarterly to the investor. So you might receive cash quarterly. If you hit the next big Star Wars, let's be real, you're getting paid for a long, long time, right?
Yes.
It just depends on how the film does. Most people will start receiving, dividends quarterly, and then at the end of the year receive their K-1 and they report it on their return. It just depends on how the movie does.
That's exactly right. Now, as the recourse debt is getting paid back, that means the loan is getting paid back. Christine, correct me if I'm wrong. Isn't anything in excess of recourse debt just cash flow to me?
Correct.
And that cash flow I report on my tax returns and pay taxes on it, but that's my cash flow. That's business income, is it not?
Yes, sir.
So technically, yes. I can have a business just by sitting down in front of my TV and watching a movie and deciding that I want to make an investment.
Yes, sir.
How hard does it need to be to save money in taxes?
It doesn't need.
It doesn't need to be too hard if you ask me, Christine.
We do it all day, every day for people. It really doesn't have to be that difficult if you know what to do. You do this all the time.
Some of these people on here, Christine, they think that they're going to have to sacrifice their life to go manage their rental properties all year long in order to save money on taxes. Christine, do we have other strategies that don't even revolve around real estate to offset their tax bill?
I talk to people all the time who say, I honestly don't want to do real estate. It's too much work. I don't want to deal with it. And I say, okay, let's pivot and let's look at this, and this every day.
And Christine, what are some of those this, and this strategies that we've been able to help people with, just off the top of your head?
Bitcoin mining, oil and gas, solar. Gosh, you got me.
Those three are right powerful in itself. If I decide to invest money into a Bitcoin mining machine, and that machine is producing Bitcoin for me every single day, do I have business equipment? Put yes in the chat box if I do. Can I write off that business equipment? I could, couldn't I? Now, I'm not going to have that Bitcoin miner inside of your house, but what if that Bitcoin miner was inside of a facility that was managed for you, and you log onto a portal, and you can see how much money you're making every single day and transfer that money to yourself every single day? Wouldn't that give you a lot of control? Strategies. That's why you guys signed up here today, isn't it? because you know that your CPA, your tax team is probably not providing enough strategies to get you to think creatively. You're willing to do the work, but you haven't been introduced to something that actually gets you excited. So you're not excited about taxes, because the only thing your CPA gets excited about is putting money into a 401k or helping you make estimated tax payments. Have you gotten sick of this yet? Be honest, put a yes in the chat box if you have. Put a no in the chat box if you haven't. The reason why you signed up for the Tax-Free Millionaire Summit was to get strategies you thus wouldn't have had access to, which is why you paid money to be here. Put a yes in the chat box if you agree. Are we doing our jobs this week? Did Christine show you something that you didn't already have access to? She did, didn't she? She showed you how you can invest money into a movie film. What would it be like for you and your kids to show up to a movie theater and your name is in the credits of a movie that you invested in? What would that mean to your family? You're making money off of a movie film that also offsetted your tax bill. That's a pretty cool gig to be able to show your kids. Now, I know my daughter one day will eventually become proud of all this real estate, but I bet she's gonna love watching the movies that I've invested in. I bet she is. And I wanna give a huge round of applause to Christine Nelson, one of our senior advisors, that said, Carlton, I want to come on and teach this strategy today. I want those members to hear it from me, because they're not going to work just with you, Carlton. They're going to be working with me and my team at Tax Alchemy. That's why she showed up here today. Can we give Christine a huge round of applause? Thank you, Ms. Christine Nelson, for coming up. And we're going to get started here today. How's everybody doing? Welcome to day 3 of the Tax-Free Millionaire Summit. I want to invite all of you back on here today. But before I let Christine go, because she's still with me right now, how many of you guys signed up to join our private client group yesterday? Put a yes inside of the chat box if you did. If you could, I want to go ahead and congratulate those members that have signed up to join our private client group. Every single person, as I name you off, I want you to go ahead and put, I am here, I am committed. I want to go ahead and congratulate Shanika Favorite. Congratulations to Shanika. Camila Lewis. Congratulations to Camila. Tolu O. Congratulations to Tolu. Madeline Zuniga. Carlos Ortiz. Sharam Nadaran. Mark Dubois. Colby Brown. Sue Forthwith. Janice Williams. Pierre Mares. Eden Johnson. Asha Nagalbo. Rafael Jarui. John Alfonso. Hector Del Aguio. Camila Cortesi, Fatima Ali Rahmani, congratulations. Kathy Story, congratulations. John Gatos, congratulations. Ronald Mackerel, congratulations. Albert Wiggins, congratulations. Anthony Nasheed, Sheila Ashbury, congratulations. Nancy Collins, congratulations. Juan Herreras, congratulations. Stacy Bell, congratulations. Let's go, Stacy. Michelle Aghu, Maureen Picot, John Woodard, Kingston Okro, Darren Pham, Terry Swanson, Diana Aguilar, Rick DiBianchi, Christopher Morel, Luke Sazone, Ryan Beal, Homera Soto, Ezra Jones, Julie Morris, Tina Valdez, Joshua Umo, Christine Ing, Ed and Joanna Justino, Thomas McAllister, Brian Curtis, William Perry, Carlotta Gomez, congratulations. Elizabeth Lee, congratulations. Fang Su, congratulations. Sheena Sapalo, congratulations. James Young and Jacob Stevens, congratulations. Jennifer Maher, congratulations. Alice Huang, congratulations. AJ Del Pino, congratulations. Ifat Samir, congratulations. Mark Moss and Christopher Mawara, congratulations. Ardini Tandaya, congratulations. Kathy Douglas and Mike Sagaro, congratulations. John Caruthers and Safi Sean, congratulations. And the last of them, Hong Su, Bob Ebherney, Joseph DeSano, and Brittany Graham. Congratulations on joining the private client group. I want to give a huge round of applause for all of you guys that have committed to take the next step. This is so exciting to be able to work with you guys. I'm so excited that we get to welcome you. Christine, these are all of our new members. I'm excited to have them here. Huge round of applause to all of you guys that have decided to make that next step. Thank you very much. We'll toss it to me, Corey. All right, guys, we're back, and I wanted to let you guys know that Christine came on and delivered a powerful strategy. How many of you guys locked in with that strategy this VIP session? How many of you guys actually understood what we were going over on that strategy? Did any of you guys see what we did? Because if you didn't see what we did, I want to share with you my K1 with this movie investment. For those of you guys that don't know, Tax Alchemy has access to production companies that will produce box office movies that we get to invest in. And underneath the tax code 181, IRC 181, we are able to receive a 4-to-1 deduction on our investment. So well, first off, because I don't have to show you guys this, how many of you guys would be comfortable with me showing you one of my K1s that went into my tax returns last year? Would you guys be okay with that? Because I don't know very many other CPAs or tax professionals that are showing you into their tax returns. So, question for the audience, I will not do it until I get 300 yeses. Once I see 300, I will show you my K1s. I will wait. I'm in no rush. Let me know once we get to 300. When we get to 300 yeses, I will show you my K1s into the movie film investment that I made last year. I will put my money where my mouth is and show you the deductions that I took that wiped out my tax bill, because you guys hear me talk on the internet, and I talk very bold sometimes, right? I talk very bold. Carlton makes 8 figures, but he doesn't pay any federal income taxes. How does that happen? Let me show you how it happens. This here is a K1 from a movie that I invested in last year. It's called Alorum. Let me know if you guys can see this. Put a yes in the chat box if you can see it. Thank you, Gregory Bridges. Thank you, Edward Boone. Thank you, Adam. Put a yes in the chat box if you can see this. All right, so you guys see my name, right? You see my name is on this K1. It was issued April 8th. Now, if I scroll down, whoops, let me go to the next page. If I go to the next page, this is the top of my K1. It shares with me everything I need to know. So this part right here is what I want you to zero in on. How much money did I contribute to a movie film, and what is my net loss that I'm able to claim on my tax returns? So in the movie Alorum, which you guys can research this movie is a Quentin Tarantino movie, a Sylvester Stallone movie. You're more than welcome to go watch it on Amazon Prime. How much money did I receive in a loss? Let me know. My eyes are getting a little bit, it's hard for me to see. How much did I receive in a loss in my first year of investing in this movie? Let me know in the chat box once you have the number. Jalon, I know you're here. How much did I get in a loss? $630,000 in a loss. But question, and let's toss it back to me. Do you think this was enough for me to offset all of my income last year? Be honest. Put a yes in the chat box if you think it was enough. Put no in the chat box if you think it wasn't enough. Here's a hint. I make more money than that. So let's go ahead and show you the next K1. I decided to crank it up a notch, and I decided to invest in another movie film, and I'll get to the K1 here. Let me show you. This stands for Cash Out to Film Holdings. How many of you guys have seen the movie Cash Out? Maybe you've seen the first movie, Cash Out. Put a yes in the chat box if you have. Be honest, put no in the chat box if you haven't seen the first one. Let's be honest. It's okay. I started doing all this research around these movies when I decided I'm going to invest, I don't know, $250,000 into a movie film. Let me show you guys. So if you guys can see right here, how much money did I put into this movie? Let me know. How much money did I invest into this movie film? Let me know in the chat box. $250,000, right? $253,000. How much did I receive in a year 1 tax loss off of this movie film? About $1 million. Okay. Now, how many of you guys remember that when we talked about exposure on day 1, how I don't like to do things through a single member LLC? How many of you guys remember that? How many of you guys remember that I told you I hate having Schedule C's inside of my individual tax return? Because I'm exposed, I have to identify all of my expenses. How many of you guys remember that I told you that when you're a part of a partnership or an S corporation, that all you receive is one K1, one number that goes inside of your individual tax returns. One number. How many of you guys remember that? Put yes in the chat box if you remember. Put no in the chat box if you've been lost this entire week. You've been lost. You're somewhere out in space. I need to send one of my tax strategy pros to come find you. Like you're up there with Mars right now. Here's what I want you to know. This $1 million loss, as well as that $630,000 loss, showed up as one line item on my individual tax returns. Minus 630, Alorum, minus 1,021,000, cash out to Film Holdings. Do you see what I'm saying here? Is there questions around Carlton's individual tax returns with this type of setup? Or if there's going to be questions, wouldn't they go to Cash Out to Film Holdings LLC? Wouldn't they go to that LLC and try to ask questions there? I receive a K-1 from that LLC because I'm a member underneath that LLC, just like other investors inside of Tax Alchemy. And what you guys learned here today is you don't have to spend 750 hours watching movie films. You only have to spend 100 hours in the year watching movies and Netflix to be able to get this deduction. Be honest and don't lie to me today. Has your CPA shown you a strategy like this before? I'll wait. That being said, how many of you guys are here today to learn offsetting strategies? We're going to get to some white paper here. I want you to have your financial literacy journal out, and I want you to write down income shifting strategies. Today is the day where I teach you guys how to shift large amounts of income off of your tax returns. Sometimes it's not enough to take $100,000 off of your returns. Sometimes we need 2, 3, $500,000 or more in deductions. And sometimes those deductions aren't going to come from rental real estate. So if you're okay with me sharing with you guys some strategies, can I show you how we can take money off of your tax returns without us having to invest money? Without us having to go into a film strategy, without us having to park money into real estate. I'm just going to show you how to move money around. Would you want to see how the wealthy move money around? First off, I just want to make sure it's okay for me to teach this to you. Are you comfortable with me sharing this with you? This is what my clients pay $50,000 a year for to get access to. And by the way, in case you didn't know, we had 51 members sign up to join the private client group yesterday. Congratulations. But of those 51 members, we already identified that there was 10 people that it didn't make sense for them to work with Tax Alchemy just yet. The opportunity wasn't right just yet for them to jump in. We aren't going to take your money if we know we can't help you. We aren't going to take your money if we know it's not the right time for us to work with you. So we refunded back 10 people last night, and there are 10 open spots to join the private client group. I'm only sharing this now because we're going to drop a link. If you put down your $5,000 deposit, my team is here available to take your call. Here's what I want to jump into. Today is about teaching you how to move money between an operational corporation, a management company, and a private family foundation. So if you have your financial literacy journal out, put done inside of the chat box. Carlton, it's done. I already have it in front of me. And what I want you to write on the left-hand side of the page is the exact same thing you wrote out when you created your T formation. I want you to write down operations, and I want you to write down assets. Now, let's start off with something simple. Let's say that I have an S corporation, and my S corporation sells t-shirts. If I decide to hire my children to work inside of my business as child models to sell some of the t-shirts that I'm choosing to advertise on my website, is that a reasonable job for my child to have relative to my business? If I'm selling t-shirts, can I have them put on maybe toddler t-shirts, children t-shirts? Is that something that I can do? Be honest with me. Put a yes in the chat box if it is, put no in the chat box if it isn't. Okay, so I can sell t-shirts or market my children as child actors or child models, which is totally great. But here's the thing. I want to make sure that when I place my children on payroll, that I'm not doing this through an S corporation. When I place my children on payroll through an S corporation, aren't I going to have to pay self-employment taxes for paying my kids, which is 15.3%, Social Security, and Medicare tax? Wouldn't I have to pay payroll taxes through an S corporation? Put a yes in the chat box if I would. Put no in the chat box if I wouldn't. Okay. Now, this is the first step to shifting income to your kids. Rather than placing your children on payroll through an S corp, what we set up is called an FMC. An FMC stands for Family Management Company. Put FMC in the chat box if you're with me, if you've heard this before. What a family management company does is it creates a contract between the operational company to receive a management fee for providing management services on behalf of the S Corporation. Your children do not have to operate inside of your t-shirt business. Your children can be part of a management company. Let's put it on me, Corey. Your children can be part of a management company that you choose to hire them through. So if we place your children on payroll through an LLC management company, which, by the way, this could be a multi-member LLC between you and your wife, I can now pay your children without being subject to self-employment taxes. The IRS allows for you to pay children up to $15,750 without your children needing to file a tax return. Does this make sense? Put a yes in the chat box if it does. Put no in the chat box if it doesn't. Now, if I have 2 children, and I'm placing 2 children on payroll for the maximum amount I can pay them, isn't that $31,500 that I would be paying out my children each? If I were to multiply this by my tax rate, which could be 37%, how much money am I saving just by placing my children on payroll? Does anybody have that math? Because I have that math for you. $11,655. Who in here, and be honest, who in here has kids? Put a yes inside of the chat box if you have 1 child. Put 2 inside of the chat box if you have 2 kids. Put 3 inside of the chat box if you have 3. Oh shit. Someone said they have 8. Put 4 inside of the chat box if you have 4 kids. Someone said they have 6 kids. Clint said they have 6 kids. Oh my, Clint, we're going to be, Clint, does this mean that I should increase the management expense from the S Corp? I think it might, right? Question, is this a tax deduction when the S Corp pays the family management company? Yes or no? Is it a tax deduction for the S Corp? Okay, it is. Is it a second tax deduction for the family management company to pay my children? Put yes in the chat box if it is. Okay. Now, with the money that neither you or I pay taxes on, could I establish a Roth IRA and put in $7,000 for your kids with the $15,750 that neither you and I pay taxes on? Is this something I can do? Yes? This Roth IRA with $7,000 in it, if you start at the age of 5, should have roughly $1 million in it if you never contribute to it again by the time your children turn 65 years old. This is tax-free wealth. This is what tax-free wealth looks like. Tax-free wealth isn't just about you saving money. Tax-free wealth is about your children being able to save money. Does that make sense to you? I'm about to get busy on some other strategies. I mean, I'm about to cover private family foundations. I'm about to cover off-year C corporations. I'm about to get carried away here. But before I get carried away, I would be remiss to not have some of my clients who are in here right now come up and share with you in their experience of working with Tax Alchemy. They sat on this event about a year ago trying to figure out, how am I